The Essays of Warren Buffett, Lessons for Corporate America, by Warren E. Buffett, selected and arranged by Lawrence A. Cunningham. Picture this. It's the mid-1960s, and there's this struggling textile company with outdated machinery, grim prospects, and an entire industry fleeing overseas. Any sane person would have run the other way. But there was this young investor from Omaha, Nebraska, who saw something everyone else missed. He saw cheap. So he bought it. That purchase, it became his biggest mistake. And somehow, also the launch pad for the greatest fortune the world has ever seen. The investor was Warren Buffett. The dying textile mill was Berkshire Hathaway. How he transformed that train wreck into a $500 billion empire is the stuff of legends. But here's the kicker. The secrets to his success? They weren't secrets at all. He's been writing them down, year after year, in plain English, for anyone willing to read. For over 50 years, Buffett has written annual letters to Berkshire Hathaway shareholders. But these aren't your typical corporate snooze fests, drowning in jargon and empty promises. These are masterclasses in business, investing, and life itself, written with Mark Twain's wit and a country doctor's clarity. They're packed with stories, folksy wisdom, and profound truths that slice through Wall Street's smoke and mirrors. The book we're diving into today, The Essays of Warren Buffett, is where all that wisdom lives. Professor Lawrence A. Cunningham took decades of these letters and wove them together by topic, creating what might be the single greatest business textbook ever assembled. It's sold millions of copies and sits on reading lists in business schools and boardrooms worldwide. But this book isn't just about money. It's a guide to thinking clearly. It's a manual for making rational decisions in an irrational world. Today, I'm going to share that manual with you. By the time we're done, you won't just understand the principles that built Berkshire Hathaway. You'll have a mental toolkit for your own financial future, for understanding the businesses around you, and for thinking with clarity and independence. Because here's Buffett's most important lesson. You don't need to be a genius to succeed. You just need a sound framework for decisions, and the emotional discipline to stick with it. Let's uncover that framework. Let's start with the single most important idea underpinning everything Warren Buffett does. It's so simple, yet so revolutionary, it flips modern finance on its head. He says, although our form is corporate, our attitude is partnership. What does that mean? When you buy a stock, you're not just buying some digital ticker that bounces around on a screen. You're becoming a part owner of a real business. You're a partner. And those managers, the CEO, the executives, they're not your bosses. They're your employees. They're the managing partners. And you're the owner partner. Their job is to work for you. This one idea changes everything. When you think like an owner, you stop asking, what will the stock price do tomorrow? And start asking, how is the business actually doing? You care about its long-term health, its competitive advantages, the quality of its management. You wouldn't buy a family farm planning to flip it next week. You'd buy it intending to hold it for years, maybe forever. That's how you should think about stocks, according to Buffett. At Berkshire, they live this philosophy. He wants shareholders who see themselves as partners, who've entrusted their money to him and Charlie Munger for what might be the rest of their lives. In return, he and Charlie treat that money like their own. Actually, it practically is. Both men have nearly all their net worth in Berkshire stock. As Buffett says, we eat our own cooking. He writes, when I do something dumb, I want you to derive some solace from the fact that my financial suffering is proportional to yours. This partnership mindset dictates how they run the entire operation. It starts with communication. Buffett believes owners deserve to hear directly from the CEO about what's happening, the good and the bad. He doesn't delegate his annual letter to some PR department. He writes it himself, with a level of honesty that's almost unheard of in corporate America. He freely admits his mistakes, sometimes in painful detail, because the CEO who misleads others in public may eventually mislead himself in private. This honesty attracts a certain type of shareholder. Buffett uses a brilliant analogy from investor Phil Fisher. A company is like a restaurant. It can serve fast food, elegant French cuisine, or takeout chicken. It can't be everything to everyone. If it tries, it'll just have a revolving door of confused, dissatisfied customers. Berkshire's menu is crystal clear. We're serving a long-term, business-focused meal. We don't care about short-term stock gyrations. We want owners who think like owners. Over decades, that's exactly the shareholder base they've built. Berkshire's stock turnover is a tiny fraction of other major corporations. Their owners are partners, not speculators. So if you're a partner, how should you expect the managers to behave? Buffett says the best managers think like owners. They put shareholders' interests first. But even great managers can sometimes have conflicts of interest. Easing these conflicts is one of Buffett's central missions. He starts by tossing out textbook management rules. He doesn't believe in complex org charts or chains of command. What truly matters is selecting people who are able, honest, and hardworking. His philosophy is simple, borrowed from advertising legend David Ogilvy. If each of us hires people who are smaller than we are, we shall become a company of dwarfs. But if each of us hires people who are bigger than we are, we shall become a company of giants. At Berkshire, this means hiring managerial stars and getting out of their way. He explains, if my job were to manage a golf team, and if Jack Nicklaus or Arnold Palmer were willing to play for me, neither would get a lot of directives from me about how to swing. But finding the right CEO is especially tricky. Buffett points out three major problems in corporate America. First, it's hard to measure CEO performance. The boss can shoot an arrow of managerial performance and then hastily paint the bullseye around wherever it lands. Second, there's no one senior to the CEO to hold them accountable. Third, the board of directors, which should be the CEO's boss, is often too friendly to provide real oversight. Criticism at a board meeting is often seen as the social equivalent of belching. This leads to a supreme irony. It's far easier for an inadequate CEO to keep their job than for an inadequate subordinate. A secretary who can't type gets fired quickly. A CEO who underperforms is frequently carried indefinitely. So what's the solution? For Buffett, it's not endless rules or committees. It's about finding directors with business savvy, genuine interest, and an owner orientation. And there's one key reform. Boards should hold regular meetings without the CEO present, solely to evaluate performance. Simple idea, potentially revolutionary impact. Even then, evaluating CEOs is tough. It requires balancing short-term results with long-term health. Consider closing a factory. A ruthless, short-term focused manager might slash jobs without hesitation to boost next quarter's profits. Buffett's approach is different. He writes about plant closings with real empathy. For years, he kept Berkshire's original textile business alive long after it became unprofitable, because he knew how vital it was to employees and the community. He finally closed it in 1985, only when it became clear it would lose money forever. He writes, "I won't close down businesses of subnormal profitability merely to add a fraction of a point to our corporate rate of return. I also feel it inappropriate for even an exceptionally profitable company to fund an operation once it appears to have unending losses in prospect. It's balanced, human, and builds trust, itself a valuable long-term asset." This owner-first philosophy extends everywhere, even corporate charity. At most companies, management decides which charities to support, often based on personal preferences or social pressures. Buffett finds this absurd. Just as I wouldn't want you to implement your personal judgments by writing checks on my bank account for charities of your choice, I feel it inappropriate to write checks on your corporate bank account for charities of my choice. So Berkshire does something unique. Each year, shareholders designate which charities the corporation donates to, proportional to their shares. An imaginative, principled solution that treats company money as owner money. Perhaps the most controversial insights deal with executive pay, specifically stock options. For decades, options have been praised as perfectly aligning managers with owners. Buffett argues that's often a dangerous myth. He explains with a simple story. Imagine you have a $100,000 savings account earning 8% interest. You hire a trustee to manage it. The trustee pays you only a quarter of the interest each year, reinvesting the rest. After 10 years, your account has grown to over $179,000, and your annual earnings increased by 70%. Now, what if you'd given that trustee a 10-year option to buy a piece of your business at its original value? He'd make a huge profit at your expense simply by holding your earnings. He didn't do anything special. The account grew automatically through compound interest. This, Buffett says, is exactly how many stock option plans work. Managers are rewarded handsomely for earnings increases that come simply from retaining owners' capital, not from brilliant strategy. As he puts it, a managerial Rip Van Winkle, ready to doze for 10 years, could not wish for a better incentive system. The rhetoric that options put managers and owners in the same boat is misleading. An owner pays for their capital and faces both upside and downside risk. An option holder bears no capital cost and has no downside. At Berkshire, they do it differently. No stock options. Instead, managers get cash bonuses based on their specific business unit's performance, after charging them for the capital they use. If the See's Candies manager does brilliantly, he gets a huge bonus, regardless of Berkshire's stock price. Want to be an owner? Use your bonus to buy Berkshire stock on the open market, like anyone else. When he does that, Buffett says, he, quote, truly walks in the shoes of owners. This fundamental philosophy, thinking like an owner, not a speculator, is the bedrock. But how does an owner actually invest? This brings us to the core of Buffett's wisdom, and his takedown of what was, for 30 years, standard dogma in every business school. Imagine walking into a finance class in the 70s or 80s. The professor would likely tell you about modern finance theory. The core idea was the efficient market hypothesis. Essentially, it said the stock market is perfectly efficient. All public information about a company is instantly and perfectly reflected in its stock price. The shocking implication? Analyzing individual stocks is a complete waste of time. You couldn't possibly find a bargain, because there weren't any. The market always knew everything. A professor might even say you could pick stocks by throwing darts and do just as well as the most brilliant analyst. This theory came with a new definition of risk. Risk wasn't the possibility of losing money. Risk was volatility. How much a stock's price bounced around compared to the overall market. They even had a fancy Greek letter for it, beta. High beta stock? Risky. Low beta stock? Safe. The way to manage risk was to diversify. Don't put all your eggs in one basket. These ideas swept through Wall Street, embraced by professionals and managers everywhere. From his quiet Omaha office, Warren Buffett thought the whole thing was absurd. He followed a different tradition, passed down from his teacher and mentor, the father of value investing, Benjamin Graham. Graham taught him that the core of successful investing was recognizing that price and value aren't the same thing. As Graham said, price is what you pay, value is what you get. The market was anything but efficient. To make this point, Graham invented a wonderful character, your hypothetical business partner, Mr. Market. Mr. Market shows up every single day without fail, offering to either buy your share of the business or sell you his. Thing is, poor Mr. Market has incurable emotional problems. Some days, he's euphoric, seeing only good news, offering ridiculously high prices for your shares. Other days he's deeply depressed, seeing nothing but trouble, offering to sell his shares at ridiculously low prices. He has another wonderful quality. He doesn't mind being ignored. If his price is silly today, he'll be back with a new one tomorrow. Transactions are strictly at your option. Buffett says the lesson is crucial. Mr. Market is there to serve you, not guide you. It's his pocketbook, not his wisdom, that's useful. When he shows up in a foolish mood, you're free to take advantage. But it's disastrous if you fall under his influence. If you don't feel you understand a business far better than Mr. Market, you don't belong in the game. This simple allegory shatters modern finance theory's foundation. The market isn't a perfect, all-knowing machine. It's a moody, manic-depressive partner constantly offering you opportunities. And what about beta, that volatility measure academics called risk? Buffett finds it preposterous. Under beta theory, a stock that's dropped sharply becomes riskier at the lower price than at the higher price. Does that make sense? If someone offered to sell you their entire business for half of yesterday's asking price, would you consider it riskier? Of course not. You'd see potential opportunity. The true investor welcomes volatility because Mr. Market will periodically offer solid businesses at irrationally low prices. Beta also can't distinguish between a company selling fleeting fads like pet rocks and a company whose sole product is a timeless classic like Monopoly or Barbie. But any ordinary person can. For Buffett, real risk isn't volatility. It's the possibility of permanent capital loss. Assessing that requires thinking about the business itself, its management, products, competitors, debt levels. This leads to another Graham core principle, margin of safety. Forced to distill sound investment into 3 words, Graham said they'd be margin of safety. Never make an investment unless the price you're paying is substantially below your conservative estimate of the business's underlying value. This doesn't just give you better profit chances. It protects against bad luck, judgment errors, or Mr. Market's wild swings. Armed with these simple, powerful ideas from Graham, Buffett feels a whole generation has been misinstructed. He jokes that fellow Grahamites should probably endow chairs to ensure perpetual teaching of efficient market dogma, because it gives them such an enormous advantage to have opponents taught it's useless to even try. So if you shouldn't diversify based on beta, what should you do? Buffett's answer flips another piece of folk wisdom. Instead of don't put all your eggs in one basket, he prefers Mark Twain's advice from Pudd'nhead Wilson. Put all your eggs in one basket and watch that basket. This is the principle of concentration. If you're a know-something investor, able to find 5 to 10 wonderful businesses at sensible prices, conventional diversification makes no sense. Why put money into your 20th favorite idea instead of adding more to your absolute best ideas, the businesses you understand most, presenting least risk and greatest potential? Buffett believes concentration actually decreases risk because it forces you to think with more intensity and have much higher comfort before buying. This brings us to the term value investing. Buffett argues it's redundant. What is investing if not seeking value? Paying more for a stock than its calculated value, hoping it goes higher, isn't investing, it's speculation. He also dismisses the common value versus growth distinction. Growth is simply one component in calculating value. The two are joined at the hip. The key is finding an outstanding business at a sensible price, not a mediocre business at a bargain price. This is a lesson he learned the hard way. Early on, he practiced the cigar butt approach. A cigar butt found on the street that has only one puff left may not offer much of a smoke, but the bargain purchase will make that puff all profit. You buy a terrible company, so cheap you squeeze out one last gain before it dies. He tried this after buying Berkshire with a Baltimore department store called Hochschild Kahn. It was cheap. He thought, how could I miss? 3 years later, he was lucky to sell it for about what he paid. The hard lesson: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. As he says, time is the friend of the wonderful business, the enemy of the mediocre. Buy a great business, time's on your side. Buy a bad one, time erodes any initial advantage. Another powerful, unseen force causing smart people to make bad decisions is what Buffett calls the institutional imperative. This is organizations' tendency to mindlessly imitate peers. If other companies are expanding or making acquisitions, the imperative pushes managers to do the same, whether it makes sense or not. Corporate projects materialize to soak up available funds, and any foolish craving of the leader gets quickly supported by detailed studies from his troops. It's lemming-like, stifling rational decision-making. Buffett saw this in the junk bond mania of the 80s. Academics and investment bankers pushed the idea that huge junk bond debt would act like a quote, 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 quote. Mounted on the steering wheel, forcing managers to be more focused. Buffett acknowledges a dagger would certainly produce an alert driver, but another certain consequence would be a deadly and unnecessary accident if the car hit even the tiniest pothole or sliver of ice. Business roads are riddled with potholes. This flawed logic led to staggering losses when the junk bond market collapsed. Another case of Wall Street enthusiasm being proportional not to an idea's merit, but to the revenue it could produce. As Buffett wryly notes, as happens in Wall Street all too often, what the wise do in the beginning, fools do in the end. This brings us to how Berkshire itself runs as a public company. Buffett's principles here are simple, counterintuitive, and rooted in his owner-first philosophy. Consider Berkshire's stock price, which famously trades for hundreds of thousands of dollars per share. For decades, people have asked, why don't you split the stock? A lower price would make it accessible to more people. But Buffett always refuses, and his reasoning gets to the heart of his philosophy. A stock split has only one real effect. It attracts buyers with short-term focus on stock price rather than long-term owners focused on business value. It encourages people who feel wealthier holding $10 bills than $100 bill. These aren't the partners he wants. He wants rational, informed shareholders who think like owners. A high stock price acts as a filter, attracting more serious, long-term oriented investors. Stock splits also increase trading activity, which Buffett sees as hugely negative. A hyperactive stock market is the pickpocket of enterprise. Every time a share trades, a small piece of the company's value gets siphoned off in commissions and fees. These frictional costs act as a heavy tax on owners paid not to government, but to the financial community. His goal is minimizing this tax by encouraging very low turnover among Berkshire owners. Similarly, Berkshire Hathaway hasn't paid a cash dividend in over 5 decades. Again, deliberate choice. Based on a simple, powerful test, Buffett believes a company should retain $1 of earnings only if it can create at least $1 of market value with that retained dollar. Otherwise, the money should be paid out so owners can invest it themselves. Many CEOs retain earnings for wrong reasons, expanding their empire, or the comfort of having more cash around. At Berkshire, every retained dollar must earn its keep. So far, the company has consistently passed this test, finding opportunities to reinvest capital at high returns. But Buffett's clear, if that ever changes, they'll happily distribute the cash. In the mid-90s, however, Buffett faced a unique problem related to his no-split policy. Wall Street firms began creating unit trusts, planning to buy Berkshire stock and sell small, low-priced pieces to the public, marketing them as Berkshire clones. These trusts would be loaded with high fees and sold to unsophisticated investors, creating a speculative bubble and ultimately multitudes of disappointed owners. To combat this, Buffett came up with an ingenious solution. In 1996, Berkshire created Class B shares, with 1/30 the economic rights of original Class A shares. This created a low-priced, legitimate way for people to invest in Berkshire, effectively making high-fee clones unmarketable. A do-it-yourself stock split that solved the problem while preserving the original shareholder base's integrity. This leads us to the final major area, how Berkshire grows by acquiring companies. Here he shares some of the most entertaining and cautionary tales in all of business. Buffett's famous for acquisitions but deeply skeptical of most corporate deals. He believes the majority damage the acquiring company's shareholders. Many acquisition-hungry managers seem mesmerized by the fairy tale of the frog-kissing princess. They pay dearly to kiss corporate toads, certain their managerial kiss will bring wondrous transfiguration. He writes, "We've observed many kisses but very few miracles." Eventually, the manager stands knee-deep in unresponsive toads and announces a massive restructuring where the CEO gets the education but stockholders pay the tuition. What are the real motives behind these value-destroying deals? Buffett suggests 3 usually unspoken reasons. One is simple animal spirits. Leaders love the thrill of the hunt. 2 is obsession with size. Most organizations measure themselves by size, not profitability. 3 is rosy optimism about their ability to fix the acquired company. Another huge mistake is using their own undervalued stock to pay for acquisitions. This is critical. A seller will almost always demand full intrinsic value for their business. But if the buyer's stock trades in the market for, say, half its intrinsic value, the buyer's using discounted currency to pay for a fully priced asset. As Buffett puts it, the acquirer must give up $2 of value to receive $1 of value. He suggests managers think of it not as buyer acquires seller, but as buyer sells part of itself to acquire seller. Thinking about what you're giving is as important as thinking about what you're getting. So what's Berkshire's approach? They call it the double-barreled approach. They look to buy either 100% of a wonderful business through negotiated purchase, or small pieces of wonderful businesses on the stock market when prices are attractive. The key is always comparing any potential acquisition with the alternative of simply buying stocks. This discipline is something most expansion-focused managers lack. Berkshire's acquisition criteria are famously simple and strict. They look for 1. Large businesses with at least $10 million in after-tax earnings. 2. Demonstrated, consistent earning power, no interest in future projections or turnaround situations. 3. Good returns on equity, with little or no debt. 4. Management already in place, they can't supply it. 5. Simple businesses they can understand, lots of technology, pass. 6. An offering price. They don't want to waste time if the price is unknown. They also promise never to engage in unfriendly takeovers. And they offer something unique, a permanent home. Most buyers are either competitors who'll eventually meddle, or financial maneuverers who'll sell again in a few years. Berkshire buys to keep. They let the managers they admire continue running their businesses with almost total autonomy. In contrast to sensible acquisitions, Buffett condemns greenmail companies buying back stock at a premium from hostile parties to make them go away. He calls it odious and repugnant. Corporate robbery, where managers use shareholder money to protect their own jobs. Sensible stock repurchases, however, are among the best uses of corporate capital when a company's stock sells well below intrinsic value. It's a way to get $2 of value for $1 of cash. To be truly successful as an owner and investor, you need one final skill: the ability to see through accounting's fog. Accounting, Buffett says, is the language of business. But it's a language that can deceive as easily as inform. To illustrate, he shares a hilarious satire written by his mentor, Ben Graham, back in 1936. It's a fake press release from U.S. Steel announcing a sweeping modernization plan. The plan involves no changes to manufacturing or selling, only bookkeeping. For instance, they propose writing down plant values to minus $1 billion. This way, instead of a depreciation charge each year, they record an appreciation credit as the liability shrinks, instantly boosting profits by nearly $100 million. They also propose paying all wages in stock option warrants, eliminating entire payroll expense from the income statement. Brilliant, funny takedown of accounting shenanigans that's sadly just as relevant today. Buffett stresses investors must use accounting numbers as a beginning, not an end, in their quest for a company's true economic earnings. Figures produced by Generally Accepted Accounting Principles, or GAAP, aren't always most useful. He offers several tools to get closer to reality. First is look-through earnings. Berkshire owns small, non-controlling stakes in many great companies like Coca-Cola. Accounting rules say Berkshire can only report dividends received as earnings, but these companies retain huge portions of profits to reinvest. Those retained earnings work for Berkshire but don't show up on its income statement. Look-through earnings add Berkshire's share of those undistributed profits back in, giving a truer picture of annual gain from operations. As Buffett says, if a tree grows in a forest, partially owned by us, but we don't record the growth in our financial statements, we still own part of the tree. Another key concept is the difference between accounting goodwill and economic goodwill. When a company buys another for more than tangible asset value, the premium is recorded on the balance sheet as goodwill, then slowly written off or amortized over years. This is accounting goodwill. Economic goodwill is something else entirely. It's the intangible value of a business, things like powerful brand names, patents, or strong customer franchises, allowing it to earn profits on tangible assets far above average. Think See's Candies. It's not the fair value of their kitchens or delivery trucks allowing high returns. It's powerful reputation built over decades. That's their economic goodwill. While accounting goodwill on the balance sheet shrinks annually, true economic goodwill of a great business often grows. During inflation, Buffett writes, "Goodwill is the gift that keeps giving." Perhaps the most important accounting concept Buffett introduces is, quote, owner earnings. Wall Street's obsessed with cash flow, typically calculated by taking reported earnings and adding back non-cash charges like depreciation and amortization. Salesmen love this number because it's always much higher than net income. But Buffett argues this is dangerously incomplete. You must also subtract a crucial cost: the average amount of capital expenditures the business needs each year just to maintain its long-term competitive position and unit volume. The result, reported earnings, plus depreciation, minus capital expenditures, is owner earnings. This is real cash available to owners to either take out or reinvest for growth. Ignoring the cost of maintaining the business is delusional. Like a car owner calculating annual earnings by adding back car depreciation but forgetting he'll eventually buy a new one. Managers focusing on cash flow or the even more dubious EBITDA, earnings before interest, taxes, depreciation, and amortization, are likely to make faulty decisions. Finally, Buffett's philosophy is profoundly shaped by tax reality. He knows taxes are a huge drag on investment returns, but a simple strategy can dramatically reduce their bite. Through his favorite comic strip, Lil Abner, he illustrates tax deferral magic. If simple-minded hero Lil Abner started with $1 and doubled it 20 times, selling and paying 35% tax each year, he'd end with about $22,000. But if he'd found a single investment that doubled 20 times and only paid tax at the very end, he'd be left with nearly $700,000 after tax. The lesson is clear. Tax-paying investors will realize a far greater sum from a single great investment held long-term than from a succession of short-term trades. This is the powerful mathematical edge a buy-and-hold strategy provides. It's not the only reason Buffett favors this approach. He also believes it's the soundest way to invest and fits his personality. But it's a massive, often overlooked advantage. As we reach the end of these essays, what's the final message? Tempered optimism and steadfast principle. Buffett acknowledges Berkshire's enormous size today makes past growth rates impossible. A fat wallet, he says, is the enemy of superior investment results. But he promises to stick to the same approach that got him here, waiting for a good pitch, staying within his circle of competence, and ignoring political and economic forecasts that are an expensive distraction for so many. Fear, he writes, is the foe of the fattest, but the friend of the fundamentalist. He promises that he and Charlie will always have the bulk of their own money in Berkshire, that they'll suffer when shareholders suffer, and prosper only when they prosper. Ultimate partnership. It all comes back to that first simple idea: thinking and acting like an owner. As we step back and look at the collected wisdom in the Essays of Warren Buffett, what strikes me isn't its complexity, but its profound simplicity. In a world that prizes sophistication, jargon, and constant activity, Buffett's message is a radical return to common sense. Think like a partner, not a player. Buy a business, not a stock. Focus on value, not price. Demand a margin of safety. Be patient. Be rational. These aren't intricate financial formulas. They're timeless principles of prudence and sound judgment. What's truly powerful is how these ideas interconnect, forming a single, coherent worldview. The reason he doesn't split the stock is the same reason he doesn't pay dividends, and the same reason he writes letters with such candor. He's cultivating partnership with a specific kind of owner, long-term, rational, business-focused. The reason he dismisses academic theories like beta is the same reason he scoffs at Wall Street's cash flow metrics. He's relentlessly focused on economic reality, not accounting fiction. For young people today bombarded with noise of cryptocurrency, meme stocks, and day trading apps, this message is more vital than ever. It's a call to tune out noise and focus on what truly matters, the underlying, long-term value of a business. It's a reminder that getting rich slowly is far more reliable, and often far more effective, than trying to get rich quick. So how can you apply this wisdom in your own life, starting today? First, start thinking like an owner of businesses you interact with daily. Next time you buy coffee, sneakers, or a video game, ask yourself, why this one? What makes this company special? Does it have a moat? A durable competitive advantage protecting it from competitors? Is it a wonderful company? This simple perspective shift is the first step toward developing the business-savvy Buffett prizes. Second, embrace the idea of your circle of competence. You don't need to be an expert on everything. In fact, it's vital to know the boundaries of what you don't know. Start by studying industries you're already passionate about and understand. Your knowledge as a consumer is a powerful starting point for your education as an investor. Third, read. Read voraciously about businesses, leaders, history. Buffett himself spends most of his day reading. This collection of essays is perhaps the best place you could possibly start. It's not just a book about investing, it's a book about thinking. It teaches you to be skeptical of dogma, value simplicity, and ground decisions in reality. That was our journey through the Essays of Warren Buffett. We've covered the highlights, the core principles guiding one of the world's greatest minds. But I'll be honest, a summary can only take you so far. The real magic happens when you hold the book in your hands and let the ideas settle. It's in the quiet moments, when a particular story or simple phrase hits you in a way you didn't expect. This summary is just an appetizer, designed to help you see if this book is worth your time. If anything we've talked about has resonated with you, if you felt a spark of curiosity or a moment of clarity, then I urge you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change how you see the world of business and your own place within it. The link to the book is in the description. Also, if you found this journey valuable, please take a moment to hit that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.